Joining us now, someone who's enjoyed that humility, Brian Belski, Chief Investment Strategist at BMO Capital Markets. Brian, how are you framing out your inherent optimism on equities given this time we are living?
Thanks for having us. It's tough to be bullish now, but as we always say, pride brings disgrace and humility generates wisdom. And you just brought some humility my way because the very first stock that I analyzed at William O'Neill and Company for William O'Neill was 3M. He literally walked me over to the filing cabinet, made me pull out the file and read it. So it is Minnesota Mining and Manufacturing.
This is
Continue. Isn't that cool?
Yeah.
So I've been thinking a lot about this, and obviously, the binary reactions of investors have never been greater, number one. Number two, I think this has a lot to do with how we react to bullet points and emotions and things like that. And I'm going to make a parallel, and it's probably not going to be very popular. So I think this is very parallel in terms of how we're reacting to what's going on in the stock market to COVID. Now, clearly, COVID was a fright. It was a once in every 4 generation event in terms of a pandemic, but the emotions in COVID are similar to, in the fear of COVID, are similar to our personal feelings with respect to what's happening politically. Then the other thing is many of my compatriots, colleagues, and competitors are not staying in their lane. They've become now amateur psychologists that are diagnosing personality disorders where they should actually be focusing more on what's happening in the economy in terms of in earnings. Here's what we know. We don't know exactly how long this is going to last. We've already positioned, we meaning consensus, that this is going to take years and years and years and years to unfold. So I believe that the majority of portfolios, strategists, economists are already positioned for the worst case scenario. What we believe in our standing in terms of the investment strategy group at BMO is this could all be over in a matter of days. We're not trying to be Pollyanna or flippant. We believe in the inherent strength of the U.S. economy, the U.S. stock market, and we still believe that we have the best assets in the world. And we're going to take negativity to add to those assets.
Bronze it. David, get a question in here before the market open. I'm going to come back because, folks, this is my third rail right now that Belski addressed. David Gura with a question.
Right, we've got about a minute till the market opens. But yeah, so I know that you've revised your year-end target. Are you doing that simply because of historical trends where you think things are going or could go? Just in the minute we have here, explain why you decided to make that revision down.
Well, again, with much humility, we have to be much more realistic, especially given the drawdown that we've had, David. And I think to have a 35 to 40% move from here to get to 6,700 would be very difficult. Can we get a 20 to 25%? Absolutely. And that is based on historical standards.
Go back to Keene theory of 1949 or 47 and use the dreaded word paradigm. When I see that word, Brian Belski, I circle it with fear. Why is this not a paradigmatic shift in the markets?
I don't think it's I think the market actually is acting like it's a paradigmatic shift. And oh, by the way, I had the very good fortune of being in Europe last week, Tommy, and talking to those great investors that have had wonderful returns if they've been investing in European stocks. And to be clear, Europe investors have not really liked U.S. stocks wholeheartedly and objectively since the year 2000. They've been reluctant buyers of U.S. stocks the last 10 years. And so they're taking victory laps with respect to what's happening now. But I think we need to think more objectively about this, Tom. I think what's happening is more of a reversion to the mean. If I go back to my Merrill Lynch days, I think we're reverting to the mean. I think, again, to go back to what I said in the beginning, we're making binary decisions in terms of we're not going to go all this way in terms of going back to this massive paradigm shift that people are thinking positioned for. I think this is simply being positioned to a shift to the mean because we went too far the other side.
Brian, we had Jeff DeGraff on right before you. So speaking of binary, let me set this up 1-2. Tom asked him, are we in a bear market? And he didn't waste more than half a second in saying yes. How about you? What's your read on where we are? Would you use the same name?
Well, Jeff's from Michigan, so he has the Midwest sensibilities. So I don't know yet. So here's what I would say, and here's what we actually wrote in a published research report. It doesn't matter if we're in a bear market. And again, we all like to put labels on. let's go back to what we said in the report. Doesn't matter if we're down 10%, 15%, or 25%. Again, we don't like it when people lose money. I think it's terrible. The market was a little bit frothy heading into the beginning of the year. We know that. However, why doesn't it matter? Because when the market bottoms, and we do think we're in a bottoming process, we don't go straight down or straight up. It's a process. Typically and historically, when we have these types of exacerbated moves to the downside, 12 months out, we're now up an average of 29.4%. So give me a 20% rally, still gets us to that 6,100 target by hopefully closer to year end. Even if we don't get there, I think we'll get closer to that than most people think. So again, I think that we'd love to put labels on things. By the way, too, and I know Jeff would probably agree to this. I've known Jeff for a long time. Is that how many people sold at the peak? Huh? How many people sold at the peak? So a lot of this is peak to trough type analysis. And again, that's more academic than anything.
Brian Belski, thank you so much. Greatly appreciate it. Let's do it again and just appreciate those comments.